All right. It's May 13th, 1 p.m. Bangkok time, Thailand time. And I welcome you all to the show. It is about 1 p.m. And in the Stotz house, that means I'm sipping my afternoon espresso and mom is on her bicycle for exercise. She's riding her stationary bicycle and she's riding for 1 hour today, listening to a podcast. So, what are you doing? Is it your lunch break? Did you finish? Are you back at work? Are you sitting on your bed? Are you at your desk? Are you in the car? Where are you? This is our time to go through the all weather strategies and try to understand what's happening in the world. Today's session, I've got a lot of stuff to go over, including the updates in the portfolios, the changes that I've made, as well as some of my other thoughts on things. So I just want to highlight to everybody that feel free to send me a welcome message. That's very nice to say hi so I know who's here. But also, importantly, make sure to ask your questions in the comment section. I'm happy to answer all the questions. It seems like questions come in slowly and then they come in all fast right at the end. So let me share my screen and I'm going to go through some of the presentation. So just give me a second. All right. So again, today we're going to be talking about the update for April, and I do have some updates for May. Remember to ask your questions in the chat. I love questions. It's great to hear from you and hear what you have in your mind. Remember, our allocations are global, right? We're investing globally, and we're trying to gain from long-term equity returns while trying to reduce the damage during equity market downturns. And we're diversified across asset classes, regions, sectors, and companies. I always like to start by reminding ourselves why we're here. We're here to build wealth over the long term. It's a long-term game. I see 6 pillars of investing success. The first is invest in stocks. Stocks have returned significantly more than bonds and gold. And owning a piece of a company means that you gain from what management team creates. The second core principle or pillar is reduce risk. Spread your portfolio across various companies, sectors, countries, and asset classes. You want to avoid overexposure to any single asset. Contribute regularly. You want to implement something like dollar cost averaging by consistently investing a fixed amount over time. This reduces stress by taking advantage of volatility and lowers the average cost, enhancing long-term gains. Number 4 is stay invested. Think long-term. Be patient because the benefits of compounding happens over decades. Number 5, maintain discipline. In fact, I was doing something like this when I was doing my yoga this morning. Follow your investment strategy. Avoid acting based on emotions by sticking to a well-considered plan. And continue learning. This is my favorite. I like to deepen my understanding of investing, and I want to stay informed about market dynamics and refine our strategies by learning from our successes and our failures. So we create our strategies for many decades, but not even a decade is long term. That's me when I was a kid. That's when I came to Thailand, and that's going to be me when I'm 100. Our aim is to create strategies that perform over many decades. I've outlined most of what I talk about and what I believe in my book, How to Start Building Your Wealth Investing in the Stock Market. So our goal is to deliver steady returns over the long run. Here you can see updates of all 3 portfolios. Red is all-weather strategy. Green is all-weather inflation guard, and blue is all-weather alpha focus. All-weather strategy launched in February of 2019 and targets 6% per annum return. All-weather alpha focus was launched in October of 2021 and targets 8% per annum. and all-weather inflation guard launched in July 2022 and targets 4% per annum. Those are the goals that we've set for the different strategies. Now, from when we started the all-weather inflation guard in July of 2022, the strategies are performing almost as expected. We did have some underperformance for a bit. I'm going to grab my pen here. We did have some underperformance for a bit from Alpha Focus, which was quite painful. But now, as you can see, Alpha Focus, the blue line, has been racing back up. And it's very possible that Alpha Focus could catch all-weather strategy. So ranking the strategies by returns shows recently that the moderate risk all-weather strategies have had the highest return. All-weather inflation guard has had the lowest return, but also the lowest volatility. And since July of 2022, all strategies have had lower volatility than world equity. AWS had slightly higher return than world equity. Now remember, we mix asset classes rather than hold pure equity to try to avoid a portion of equity market drawdowns. But it also means that we oftentimes miss a portion of the market booms. So before I get started, I just want to go back to the presentation for a moment. And I just want to talk to you for just a moment. I see some of you have said hi. So I see at Wise Wealth says Sawadee Ka. And Tarinrat says Sawadee Karap, Kunandru. And Sati Medi says hi. Hello to everybody, and I'm glad that you joined. We have about 141 people now on this call. Does that mean that we're going to get 141 questions? Well, maybe not 141, but hopefully you've got some good questions that you want to ask throughout today's presentation. And feel free to type those questions in the chat now. All right, I'm going to go back to the presentation and look at the performance in April of all-weather strategy, which fell 1.7%. Of course, it's recently rebounded, but this gives a picture of performance in April. Now, we've been 85% weighted in equity, which you can see right there, with 25% in the US, 25% in developed Europe, and 25% in Japan. Everything else has been a 5% weighting. Since inception, the strategy was up 42.5%. And we can see here that it's been 20.9% above a 60-40 portfolio. Here we can see that the strategy was down 1.7%, which was 1.6% above the 60-40, as you can see in this case. Our 25% target allocations to developed Europe, Japan, and the US performed relatively poorly, but still only US equity was below the world. So our low bond allocation also helped the strategy relative to the 60-40. Before I go into Alpha Focus, I just want to highlight that today at the end of this presentation, I'll be talking about our new weights. So make sure to stick around and you may have more questions then. So equity in Alpha Focus is at 95%. Bonds are at 2% and gold are at 3%. And here we can see that since inception, Alpha Focus strategy was down 1.3% and about 7.4% above the 60-40 portfolio. And we're about 1.8% above world equity with a lot less volatility. So here we can see in April of 2024, the strategy was down 1.4%, which was 2% above the 60-40, as we can see. So even though we were down, we were almost down by half of that. So that made me feel good. Our 22% tilt to India outperformed greatly. And our 22% tilt to Infotech was slightly better than the world equity, while Europe small caps underperformed. It just goes to show that you win some and you lose some. Now let's look at all-weather inflation guard, which fell 1.9%, a pretty big fall when you think about it relative to the others. Well, we're 30% in equity and 65% in bonds. Here we can see that since inception, the strategy was up 5.5%. And it's about 8.4% above a 40% equity, 60% stock, 40% equity, 60% bond portfolio. And the strategy has experienced less volatility than the 40-60. And here we can see that it was down 1.9, which was 1.3% above the 60-40's 3.2%. Our 5% target allocation to gold did great, and tips also did well. And our 5% target allocation to financials did well relative to other equities. Now, before we go on, I want to talk to you briefly about this, because here you can see, in fact, about this strategy is that we're choosing from a lot of different asset classes like stocks, bonds, commodities, and gold. And we're mixing it up within the equity asset class also. And what the all-weather strategies did in April when the market was down is that the strategy was down a lot less. And that to me is like huge success. You know, most people, when they look at investing, they look at the upside and they look at when the market's up, how much does this go up or how much has it gone up? But for me, what I really care about is the downside. If I can reduce the downside, then I believe that I've really done my job. And I think that when you look at my job as a strategist, it really is to set a long-term direction and a long-term strategy and try to stick with it so that if you are riding the roller coaster of the markets, I'm not. So the downside that we saw relative to the benchmark was much lower. And that made me just so happy that I think I'm going to have a sip of my last sip of espresso. Did you understand what I mean when I say that when the market goes down, if we go down less and a lot less in this case, that I feel good? You know, is that the way you feel? Or are you really hooked on the upside? I know most people are hooked on the upside, but for me, I'm all about the downside. All right, I'm going to continue on into the presentation. So let me go back to the presentation and speak a little bit more. So now I just want to talk about our global outlook that guides our asset allocation. The Fed has succeeded in getting the market to expect higher rates for longer. Can see that bar, this is May 2nd of this year versus May 8th of the prior year. So there's been a tremendous shift upwards, and the market thinks the Fed is done hiking. No one bets on more hikes from here on. In other words, the top is very, very flat. Now, the Fed has held rates high for a long time. So I'm looking at this black bar that I put in there. Now, assuming that we're at the peak interest rate, the Fed has held the rate at the current level for 10 months. Only building up to the global financial crisis has the Fed held up the peak rate for longer. And this is part of, again, I haven't changed my view that I think eventually the Fed's going to have to cut rates and cut them seriously. And I'll talk more about that. But just looking at this example here, you know, you see no case where the fall in rate just happens slowly, except here. You can see a drift down, right? And what you can see here is a collapse, a collapse, a collapse, and I expect still a collapse here. Feel free to ask any questions if you have questions about this. Now, the market expects the Fed to start easing in September. By December of 2024, everyone believes the Fed will have lowered rates. That means 100% probabilities by this time that we get to December that they'll have been easing rates. Falling rates typically have an expansive effect on the economy. Now, bonds are typically a safe place to be. In recessions, safer assets like government bonds typically have performed well. Though with high inflation, low yields could still lead to negative real returns. Now, we generally don't allocate to bonds to speculate on the upside, but rather use them to protect capital over time. So this is a great chart that shows the fund that we're using right now for diversification. And it's a 250-day rolling correlation to world equity. And you can see it is rising recently, but still, even rising, it still gets to about 40%, which is pretty low correlation. Now, oil prices can remain high. We have seen some fall in oil prices back down to about 85 or so, but demand has improved or increased, and there seems to be strong support for an oil price around 70. So here is 70 where it's hit before. So could oil prices fall from here? Yes. But would they fall below 70? Maybe not. I expect that oil demand will continue to be strong. The conflicts in Ukraine and the Middle East can lead to supply shocks and push up the oil price. Now, there's been a broad move in commodities. You can see here, I look at the red line, which is overall commodities, and then energy, which has been the driver, and non-energy. So in 2023, it was mainly energy that moved the commodities index. Precious metals have been strong due to geopolitical and financial uncertainty. Industrial metals have seen increasing demand and constrained supply. Now, the global outlook remains uncertain. Commodities can do well in inflationary times. However, we still think the main upside in commodities would come from a supply side shock or adverse weather conditions or significantly higher demand due to improved growth outlook. Those are things we're not seeing right now. Now, central banks have loaded up on gold, maybe switching from US dollars. This shows that in 2022 and 2023, the total demand from central banks and other institutions was almost as great as in the 5 preceding years. And so what we're saying is the combination of that is, all of this combined. But here we are, we're at our first quarter of the year, and we're at about 300, which 300, of course, times 4 quarters equals 1,200, which would be right at about this level. So if things continue to trend, the gold buying will continue and rise for another year, and that would be an increase of about 20%. So demand continues to be strong by central banks and other institutions. And of course, we can see the price of gold rising. Gold tends to do well in uncertainty and market downturns. And this move kind of gives us some anticipation that people are switching into gold because of market downturns. We have to be careful because if the market does start to turn down, you could see a situation where gold starts to come down again. So gold is typically a safe haven in times of geopolitical tensions and financial turmoil. And rising government debt in major economies can raise concerns about credit quality and stimulate the gold price. Here we can see that gold has strong momentum. Based on the previously mentioned reasons and sticky inflation, gold has gained momentum. We think it can continue. We can also like to keep gold as insurance in the portfolio. We raised our target allocations to gold in addition, which we'll talk about more. Well, it's time to announce our allocations, but before we do that, let me just revisit and talk to you guys for a few minutes. So we got some questions coming in. I want to address some. So KK Gao says, I would love to have less downside on the AWS report. Oh my gosh, Gao, I've already cut it by 50% of the downside. I don't think I can do any better than that. That is so hard just to get to that point. But I appreciate you pushing me to try to get better. Yes. All right. Cindy Knott says, could you please kind of give comments about Japan stock from now to the next 2 months? So you're going to see in this presentation just after this that we've cut our Japan allocation. And basically, I'm concerned about a runaway currency and fears about what's happening in the Japanese economy and market. And so that's right now I'm reducing the position in Japan. So I'll talk a little bit more about Japan in just a bit. So we'll go through that. Let's look at some other questions. How will the increase of U.S. debt affect Fed decisions on interest rate? Well, Fed wants to keep interest rates high to slow down the economy, but when they keep interest rates high, it causes the interest expense for the U.S. government to be super high, and that causes the interest expense to be over $1 trillion that the U.S. government pays out to the bondholders. And that is now more spending than they spend on almost anything else, particularly more than military. And so the government is putting pressure eventually on the Fed to lower rates so that they don't have this burden. And so that's what's going on. And the Fed chairman is independent, and he's saying, I'm not going to lower rates until the economy has slowed down, until inflation has slowed down comfortably. And so I think you have a competing force between the Fed that wants to keep rates high and the government that wants to bring rates down. And eventually, I think the government's going to win, particularly considering that it's an election year. All right. Sininat says, can we start to invest in Japan stock at this moment? For me, I'm out of Japan. I had a good run in it. I may revisit it, but I'm out right now. So Sati says, concerned that low drawdown is a new idea for me and feeling interesting. Yeah, it's a critical thing, right? If you lose a lot of money during a downturn, it's very hard to get that back. All right, next question from Chalern Pot. Chalern Pot says, in AWS, you're raising the weight of gold at 25, but its one-year performance was plus 15. Don't you think it's getting expensive now? Would bonds be a safer position to protect the downside? Yeah, I think it's a trade-off. I think that it's possible that gold is getting expensive. Of course, we don't have a great way of measuring the value of gold. And really, it's a little bit of a guessing game at this point. So if you felt more comfortable to be in bonds, for instance, then maybe you would switch out of equities and into bonds. For me, I was comfortable with the momentum that I was seeing on gold, that I felt like it's worth it to get into gold at this point. But you do have a good point. And, this is the trade-off. I may be wrong with gold, but let's see how it goes. But it's a good question, and it's a good point. Gal says, as we want to use gold as protection, why do you think 25% will be an appropriate proportion? I think this is a great question, and it's a chance to explain a little bit about my methodologies. So basically, each of the different asset classes we allow to go up to 25%. Now, typically, you wouldn't hold gold in a portfolio at 25%. That's just too high. You want to have majority of your portfolio in stocks. But you have to remember that our strategies are active. We're trying to capture return and trying to pick up return if we can. And as a result of that, we will switch into and out of different asset class when we think it makes sense. But if you only switch, let's say 5 or 10% into gold, then you're never going to really get a long-term strong return for all-weather strategy. You have to make kind of a big bet. And that's why the 25% is a big bet. If you were managing your own money and not trying to be active about it, you may keep your gold lower. The same thing that we've done recently, and I'm going to talk about it in just a bit, that we've lowered our U.S. exposure to 5%. That is an incredibly big bet. If the U.S. moves against us, it's going to hurt our performance. But if we don't take some big bets within some framework, not exceeding 25%, if we don't take those big bets, we're never going to get the returns. Gal said, okay, my apologies. The comment above, I should have said, I aim to have low downside from AWS. Okay, great. Yes, I'm happy to hear that. I was a little worried. Okay, Chalern Pot says, why do you pick China A shares over 8 shares for AWS? Well, it's a little bit about the funds. And as I look at the various funds, I'm balancing the performance of the funds relative to the index. I'm balancing the cost of the funds and, trying to understand the history of the funds. And so the fund that I ended up using was the China A shares rather than H shares. But if, let's say, you were buying individual Chinese stocks, I think you probably would buy H shares. So it just depends. I look at all the different options that we have for funds, and then this is the one that I picked this time. Next question is, should the Bank of Thailand cut rates? Well, one of the things about Thailand that we've been so lucky is there hasn't been like runaway inflation, and there definitely hasn't been asset inflation like the market going up. So I don't think that the Bank of Thailand should be too worried about inflation. So from that perspective, a rate cut could be in order for the Bank of Thailand. The only concern about a rate cut is that if you start to lower the interest rate differential between the baht and the dollar, then you can potentially weaken the baht. And it's a trade-off. It really is a trade-off. So I can say at this point, I don't have a strong opinion about whether the Bank of Thailand should cut rates. All right, let's go. So Supergon says, how does the relation of Asia x China x Japan related to U.S. market as we move to this portion for 25%? Basically, I would say it's a good question that I don't have the answer off the top of my head, but we can calculate the correlation between the two. The one thing that's been happening, the correlation that has been really low has been China and the U.S. As the U.S. has been going up, China's been going down. But I would say for the rest of Asia, it hasn't been going down like China. So the correlations have been kind of maybe a more positive correlation to the U.S. than China. But I don't really want to see the negative correlation for China in the portfolio. I want to be careful about that. So yes, in your TLF-VMR Asia X, what are you overweighting and underweighting positions right now? Well, the main overweight is Australia, Malaysia, and Korea. And I'm going to talk about that just a little bit. Underweight is all the others. The other ones, I wouldn't say that they're underweight. I would just say that they're neutral weight. Let's think of it that way. But technically, yes, all the others are underweight. We'll look at that in just a moment. Panawit says, what is your view of the emerging markets, especially now the dollar may be weakening after interest rates cuts? I mean, ultimately, the underlying business and economy of the emerging markets, I think, is strong and great. And so from a business perspective, I am happy that I have, for instance, my business Coffee Works here because I think there's a lot of growth ahead. And so overall, I feel positive about the economy and the lack of serious debt and all that. But what ends up happening is that the emerging markets tend to be what we would call whipsawed, meaning that when the U.S. goes down, the emerging markets go down more. When the U.S. goes up, what we've seen is emerging markets haven't gone up as much. So they're a bit of a risk trade that I'm a little bit nervous about it right now. But in theory, with the dollar coming down, we should see emerging markets starting to rise. Peter Pan, any comment on Thai policy interest rate? I don't have a strong comment. I did mention before that I'm kind of neutral at this point, but I don't see any major concern of inflation in Thailand from my perspective. Chan Pen says, should I invest new money about 500,000 baht or more in AWS now? For me, what I try to recommend to people is be consistently investing and stay invested in any strategy that you're investing in. But what I would say is that it's better to invest in AWS close to the time that we've done the rebalancing, and that is now. So the answer to that is that I think I would be investing myself if that was, right, looking at it right now. Supergon, can you explain more reasons to keep EU at 25? We're going to get to that. I'll talk a little bit more about it. I would say it's a little bit of a non-consensus call, but I just think that Europe is kind of blown out right now. So we'll come back to that. All right, I'm going to go back to the presentation and talk about the new portfolio allocations, and I'm going to come back and answer more of your questions. But I just want to thank everybody for attending. We have 204 people on, and your questions so far have been excellent. Now, as I go into the final stage, feel free to ask any questions, and then I'll come back into that. So it's time to announce the new allocations. We've conducted significant research and testing to treat China separately in AWS. This has resulted in some changes in the investment universe for the strategy. We'll replace the Tisco Global Emerging Markets Fund and the Tisco Asia Pacific X Japan Fund. And we'll use the Thales FVMR Asia Pacific X Japan X China, and actually it's X Hong Kong. But we don't want to call it triple X. Maybe we call it 3X. And we're going to use the KKP Emerging Markets X China and SCB China A Shares Fund instead. So now my business, A. Stotz Investment Research, is a research provider to Thales. Our proprietary FVMR framework is used to identify the markets that appear most attractive. Thales's fund managers and investment committee then take the research under consideration when determining their markets to overweight. Now, we change our Japan equity fund to ASP NGF mainly because of the performance. It's delivered better returns on an absolute and risk-adjusted basis, and I think there's opportunity there. So we've switched that one. And I think there's a lot of opportunities for stock picking in Japan. Here is a breakdown of all the companies in Japan and the number grouped by the number of analysts. You can see that only 171 companies in Japan have greater than 10 analysts, and more than 1,000 companies have no analysts covering it. And really, when you look at it, this and this is almost no analysts. If we divide it in half, I'd say 1,448. So 1,448 companies really don't have real coverage. So there's a huge opportunity there. So given the low level of analyst coverage in Japan, we think there's a lot of mispricing for stock pickers to exploit in Japan. We also exclude the less attractive assets at each revision. So until now, we have allocated 25% to the three most attractive assets and 5% each to the 5 other assets in our asset universe. Now we've changed in that we're treating China separately. The number of assets has increased to 9 from 8 that we could potentially have in the portfolio. So we'll continue to allocate 25% to the 3 most attractive and 5% to the 5 others, or actually 6 others. This means we'll reduce the least attractive assets each revision to 0, but also keep at least 5% in bonds and golds respectively. So I'm explaining a little bit more of our methodology there, but that's a small change that we've recently made. So one of the other things I'd highlight is we don't change our methodology very often. So when we do, I try to explain a little bit about what we've done. So the question is, why have we excluded China? Well, we wanted to have the flexibility of removing China exposure in the strategy. This gives us the ability to move China exposure to 0 if we think that geopolitical pressure is high. In fact, I'll talk for a few minutes here about what I'm seeing in relation to China. One of my big concerns is that I haven't seen any U.S. politicians, both Democrat or Republican, try to slow down the rhetoric against China. In fact, I think that both Democrats and Republicans are on a war path with China. It may not be a hot war, but it will be a war for resources, for power, for money. In fact, a while ago, I talked about my idea from an investment strategy perspective that I think we're in we just had World War 2.5, and that was America conquering Europe. And the objective of conquering Europe was that U.S. can now control Europe so that both U.S. and Europe can start to attack China. Again, it may not be a hot war against China, but it may be a cyber war and many other types of methodologies that they'll do. And this is my concern. I also have concern that at some point, U.S. institutional investors will have to pull their money out of China because either the U.S. government has said that they have to, or their risk committees are telling them that they should, or you may even see something very bold that I'm going to predict here, that the index provider, MSCI, may end up having to reduce the China exposure into their index. And their emerging market index has a large exposure of China, but it's not nearly as large as they've been planning, and they've held off on adding it. So China is a wild card to me. And by creating this new fund with Thales, we've been able to basically come up with a way to remove China from the portfolio. Now, it doesn't mean that we're going to not make a bet on China. If I see the Chinese market having some sustainable run, I may switch into the Chinese market, and I'll do it through the A-shares fund. All right, that gives you a picture of China, and feel free to ask any questions about that because that is a pretty significant change. All right, ladies and gentlemen, it's time for the new weights. Well, we've reduced equity in Alpha Focus down. In fact, hold on one second. This is all weather strategy, my mistake. We've reduced equity to 65% from 85%, and we've increased gold to 25% for all weather strategy. We keep our 25% target allocation to develop Europe, and we reduce Japan and the US to 5% from 25%. These are some big bets. We could be wrong, but this is what the FEMR model that we use, that I've developed over 10 or 15 years, is telling us right now. And we've raised Asia Pacific ex Japan ex China to 25%. And finally, we've added China at 5%, and we've exited emerging markets. This is the change that we've done in all weather strategy. Now, for the past year, we've said that we think that the course will eventually be reversed. I expect that central banks, and particularly the Fed, will reverse course and have to reduce rates. And I expect that massive rise in rates will eventually break something in the U.S. economy. When the news turns negative and markets start weakening, I think that the Fed is going to reverse course and bring rates back to near zero. A no recession scenario appears to be priced in, which constitutes a risk if the Fed fails. Ultimately, I stand by my prediction, which has been wrong up until now, that the Fed is going to seriously reduce interest rates. Now, this is a good chart that shows the U.S. GDP, which is the red line, and U.S. total public debt. Such a major thing has happened in America, bankrupting the country practically and making the rich richer. But since the 2008 crisis, the government has taken on a ton of debt to bail out banks and the population. The real divergence started after the global financial crisis. And given the high interest rate, the U.S. debt service has become more expensive. The unproductive budget deficits are unlikely to drive the U.S. economy. It's just maybe 25% of the total government budget is now going to go to interest costs into other people's pockets. Now, the U.S. matters for the rest of the world. The IMF Fiscal Monitor predicts that the U.S. debt to GDP ratio will continue to rise. And due to the U.S.'s central role in global financial markets, it matters for the rest of the world if the U.S. public finances are out of control. Persistently high deficits could put upward pressure on treasury yields and lower growth in the U.S. and globally. So we reduced the U.S. to 5% from 25%. 25 was already a low level of U.S. exposure, considering that U.S. accounts for about 60% of global equity. But now bringing it down to 5% is incredible. If the U.S. goes up massively, I'm going to underperform for sure. Now, the EU equity trades significantly below both U.S. and Japan. And that's part of the attractiveness that the economy has already faced a lot of its down cycle. Purchasing managers have become more optimistic in the EU, which we can see with a rising PMI. The composite PMI Purchasing Manager Index has risen for 5 months in a row. Now, European inflation is coming down. The peak rate is expected to have been reached, and ECB may cut before the Fed. EU companies are resilient. They're used to operating in a sluggish growth environment, and being a global leader in industrial automation, the EU could benefit from reshoring. Investors have low expectations for developed Europe economic outlook, and we see a chance for the region to surprise on the upside. So we're keeping our 25% target allocation. Now, the yen weakness is likely to lead to more government intervention. We originally went into the Japan portfolio, actually right around here. And this high volatility exchange rate can also have a negative impact on both businesses and foreign investment flows. So we're now, after running up to Japan, we're now reducing Japan to 5% from 25. And here we can see, in partially answering some of the questions that came before, a strong US dollar typically hurts emerging markets. And therefore, could a weaker dollar benefit emerging markets? I think so. I think we have some potential there. Strengthening US dollars is negative, and we exit the emerging market funds used in the strategy. But part of that exit is that we're also reallocating to Asia through the Thales Fund, the Asia ex Japan ex China, which still keeps us having some exposure to emerging markets. So why is a strong dollar bad for emerging markets? Well, emerging markets borrow some in US dollar, which makes it more expensive to service and repay. And the cost of inputs, like of capital goods and commodities, can rise when a dollar is strong, and that depresses margins and pushes up the price of exports. And investors move to US dollars when risks are rising, which could bring dollar strength and emerging market outflows. And a strong dollar may cause local central banks to defend their currency by raising interest rates, which can slow their economy. I'll just talk briefly about that. So one of the things that I would say here is that though we have reduced our emerging markets exposure, I have to say that part of that reduction in emerging market exposure is due to the introduction of the Thales Fund. And the Thales Fund does give us exposure to emerging markets in Asia. And so we didn't want to necessarily double up on that in Asia. And that's part of the reason why we've reduced some of that emerging markets exposure. Now, going back to the question that was asked previously, which was asked by Panawit, who said, what's your view on emerging markets, especially now the dollar may be weakening? So the first part of this answer is that we're getting out of emerging markets because of our switch into the Thales Fund, which already gives us some emerging market exposure. But I can tell you that our model is not putting emerging markets at the top right now. And so that's part of the reason why we're out, is because the signals are not there. Part of it is, for instance, the momentum in emerging markets. But I would say from a fundamental perspective, you should expect that emerging markets could outperform if the dollar starts to really weaken. There's 226 people on this call. I want to welcome everybody. And I also want to invite you to leave any questions that you may have, because I like your questions and I'll try my best to answer them. But for right now, I'm going to go back to the presentation and continue on. So China stocks have started to move. China continues with easy monetary and fiscal policy to stimulate the economy. And stock market sentiment has improved and prices have started to move as the Chinese regulator has announced reforms to increase scrutiny and enhance shareholder returns. We've added a 5% target allocation to China. And there's a risk that Chinese stocks could underperform due to geopolitical risks. So part of what we're doing here is when we switched into the Thales Fund, we basically got rid of China out of our strategy. And we felt like we always need to have an ability to make a target allocation to China if it starts to move. And that's where right now we're starting at 5%. Our Thales Fund is not saying that we won't ever invest in China. It's just that I want to have the flexibility to get myself out of my Chinese exposure. Now, Asia Pacific ex Japan ex China has many engines to drive stocks further. A strong dollar and geopolitical tensions are challenges for the region, though the US-China conflict can lead to relocation of production to Asia ex Japan or ex China. AI and EVs need semiconductors and batteries, and Asia produces most of these. In addition, the region produces many essential commodities and stands to benefit from rising commodity prices. So we've added a 25% target allocation to the Thales fund. Again, we're a research provider to Thales. We're using our FEMR framework to identify the most attractive markets, and then we're providing that to their fund managers and investment committee so that they can do their research and make their decision about the weighting positions. We are not the fund managers of the fund, and we're not basically taking responsibility, let's say, for the fund management of the fund. That is the fund manager and Thales. What we're doing is we're a research provider to Thales, providing them with all of our research so that it can enhance their abilities to pick. Now, the fund currently overweights Korea, Indonesia, and Malaysia. Now, in Korea, we see semiconductor exports picking up. Korea is the second largest semiconductor producer in the world, and AI momentum has brought back demand. In first quarter, Korean semiconductor exports bounced back by about 42% year on year. Now, the Korea discount could be reduced by the Corporate Value Up program. The Korean Financial Services Commission and the Korean Exchange have launched the Corporate Value Up program and index to attempt to reduce the discount of companies in their price to book and PE discounts. Like Japan, Korea wants companies to disclose plans on how to reduce valuation discounts. Speculations are that $8 billion could be invested in the index by Korea's National Pension Service and its external managers. Now, in Indonesia, we have a new president who's expected to continue the work of the previous administration. Prabowo is the new prime minister or president coming in. While some concerns about protectionism, Prabowo is likely to continue the former president's policies to support economic growth and low inflation. Now, Indonesia is also well positioned to ride the global EV momentum. Indonesia aims to become a global top 3 producer of EV batteries. Nickel and cobalt are 2 vital resources for that. And Indonesia is the largest nickel producer in the world and the second largest producer of cobalt. So they're in a good position. In Malaysia, exports are picking up. Malaysia can benefit further from a shift in supply chains due to geopolitical tensions. A recovery in China's economy could support Malaysia as it is the largest export market and also accounts for a large share of Chinese tourists. To benefit from AI, EV, and tech optimism is what's happening in Malaysia. It's the 6th largest semiconductor producer globally, and the semiconductor industry contributes to about 25% of GDP. It's the building block of computers, mobile phones, and self-driving cars, AI, and much more. So let's look at the alpha focus. We have reduced equity to 68% and raised gold to 19%, increased bonds to 13%. We've raised healthcare and infrastructure to 17%, and we've reduced infotech to 3%, and we add 3% to energy and financials, respectively. We're exiting small cap Europe and India. So demand for fuel is expected to outpace supply in second quarter of 2024. Given the demand, oil prices can remain strong, and the energy sector can make good margins. We've added a 3% target allocation to world equity. Now, financials should benefit from a more stable rate environment. We're just adding in 3% to world financials. High interest rate volatility is troublesome for financials. Interest rates might be kept stable for another 3 months at least, and financials could start closing the gap since the U.S. regional bank crisis in March of 2023, which you can see in this chart. Now, there's a growing population which supports demand for healthcare. This is actually, a big issue of what's happening with the aging of society. We can see up to that point so far. By 2050, the population above 65% is projected to have grown to about 800 million, or 36%, or by 36%. Old people demand more healthcare. As such, demand should be strong for the sector in the long term. So demand for care and drugs is independent of economic conditions. Given a more defensive equity outlook, we've increased our target allocation to 17% in the defensive healthcare sector. Now, this time it's different. Seriously. Wait a minute. Have we heard that before? I think so. At least one thing that is different this time is, compared to the late 90s, the dot-com bubble, is that many big tech companies are quality companies. The key thing to the dot-com bubble was that almost all of the tech companies that went up so high in their price in the dot-com period, almost all of them were losing money. But now those tech companies are highly profitable. Their ROIC is very high, and they have strong balance sheets. And quality stocks should do better in an environment of higher interest rates. So Infotech has driven the market. We think the momentum driven by the positive AI sentiment can continue, and we've up to 3% target allocation. And befitting from government's green energy security, and other infrastructure spending. Typically, predictable cash flows and infrastructure is able to push through cost increases from inflation. So we do like the defensive nature of infrastructure. The infrastructure fund we're using has heavy exposure to global and energy transition. So if you love ESG and climate change and energy transition, then this fund has exposure. Long-term demand should be very strong for electrification and AI. We're raising our target allocations to 17%. That's a big increase. And then finally, all-weather inflation guard. We've reduced equity to 25% and increased gold to 10%, and we've added in 5% in commodities. We've added 5% to world energy, and we exit world financials and world infotech. We've reduced global bonds by 5%. So that gives you a picture. But before we get to the Q&A, the Valuation Masterclass Bootcamp number 16 starts on July 8th. Bootcamp 15 starts tonight, and we're super excited. We help finance professionals become valuation experts in months rather than years. We have many previous attendees from Phenomena, like Chatchada and Tossapon and Takon and Jutamas. They have been either advisors or investors at Phenomena. And Bunsim also, and Pongsakon are some of the people that have come from Phenomena. So in the Valuation Masterclass Bootcamp, it's a 6-week guided intensive online valuation bootcamp. If you got a bored kid standing around over the summertime, well, this may be a good thing for them. We have daily live sessions, team support, progress tracking, and many other things. You write and present a full professional valuation report. Now, you get an extra $100 off, so you're going to save $900 and get 6 bonuses today. Just use that coupon there, and you can learn about all 6. All right, it's Q&A time, and let me now, I'm going to exit this, and I'm going to move to Q&A. There we go. All right, let's see some of the questions that you guys have. 1 second. Tosin says, you have not switched out on SCB comp, which is very negative. Reason, please, thanks. I emailed this query via Phenomena but only silence. I don't have a good answer for you right now. We've been using this fund, but I'm going to have to get back to you on that. And I'll talk to Alex and Sornsa, because I know Alex has tried to answer this question, and I haven't gone into the detail comparing the funds. But what I can say is that the commodities fund, what's happening is we're looking at the commodities fund in relation to our equity strategy. But Tosin, you're going to have to wait for me to talk to Alex to get back on that, and I will get back on that. What's your idea about China tech stocks? Can we buy more at this moment? I don't think that you should take advice from me about what stocks to buy or what sectors, because you have to think. When I do strategy, I'm looking at a very big picture. I'm not normally looking at a lot of little ideas in stocks or in sectors. I do that every 3 months through my FVMR framework. And once I've done that, then I present that to you. So if you were to follow and double down on some of my strategies that I did, I think that's not a bad idea. But I would say it's better just to follow AWS rather than try to bet on where China tech is going. Korean stocks seem to be good to move into now. Possible. I hope so. We'll see. Any comment about semiconductor stock? No. In this session, I don't really talk about individual stocks so much, just because we're doing asset allocation. So also, I'm trying to talk about what's going on in relation to the strategy. That's the reason why I don't talk that much about individual stocks in this session. Do you have expected return from this new portfolio rebalance? Well, in some ways, I would say most people who talk about expected return don't really know what they're talking about. Gal, what's happening is that most people will pick a number of their expected return, and then what will happen is it'll be above or below that number, maybe in the next 3 to 6 months, and then they'll be either right or they'll be wrong. But what we know is that it's very hard to predict month to month, quarter to quarter, week to week movement. And that's the reason why I wouldn't make any expected return expectations for the next, let's say, 3 to 12 months. In fact, for our expected return, we've talked about for many decades ahead. Remember, I said AWS at Alpha Focus at 8%, AWS at 6%, and Inflation Guard at 4%. So that gives you a little picture on it. What are the top 10 holdings, Chan Pent says, in the Thales Fund? Well, it's important to remember that the Thales Fund is not a stock fund. It's an ETF fund. And there's about 10 ETFs that we're balancing in there. And therefore, doesn't really make sense to say top 10 holdings. Normally, we apply that to a stock fund. And so I think what's probably more important, John Penn, is that we say, what are the top 3 overweight positions in the Thales Fund? And we've talked about Indonesia, we talked about Malaysia, and we talked about Korea. Those are the 3 overweights. But applying this 10% is not the best way to do it. Boonsim, good to see you. Hello, Andrew. I wonder, when should we increase U.S. stocks in the portfolio again? What should be good trigger points? Well, it's a good question. I think that you have to be very careful about investing following my strategy, right? For instance, if you're looking for ideas of what I'm doing and thinking, okay, Andrew's underweighted the U.S. and then he's going to overweight, you want to be very careful about that, because I'm, creating a strategy looking at the whole picture. Now, it's very possible that we go overweight the U.S. again and go up to 25%. It's possible. It could happen. But I just don't know right now, because we've got to let things play out. It's a little bit like cooking, right? You put the food in the oven and you got to let it, go so that you can cook it. And that's really what we're trying to do. And so I don't have any plans to get either out of or more into the US anytime soon. Basically, in 3 months, I'll reevaluate it. Panaway says, is it a good idea if we invest in all 3 of your portfolios? Well, it really depends on where you're at. I don't think you need to invest in all 3 portfolios. I think you should pick one that most suits you, but I'll leave that up to you. But if, let's say, I'm looking at your picture and you look young, so you have a long future ahead. If that's the case, I would say you probably don't need exposure to inflation guard. Whether you decide to mix alpha focus and all weather, that's possible, but it just depends on, what your goals are. Yeah, so Anjali says it's a good time to invest more in AWS. Well, just want to go back to this point because I made it earlier, and that is my goal with my clients and friends and my money is that I'm investing every month because you just never know when you're right or wrong. And therefore, my suggestion is that you should always be investing in the strategies that you like and that you like to follow. But I would also say that we rebalance AWS every 3 months. And if you look at the performance, it's better to get in to AWS right after we rebalance, which we've just done. And so that means it is probably a good time. Gal says, thanks for your answers. Ka, you're welcome. All right. Salaya says, will you switch back to B Innotech once the Fed cuts rates? It's possible, but I won't make any judgment on that right now. All right. U.S. oil and gasoline supply increases more than expectation. Could that be the factor making oil prices drop? Yeah, I think it's very possible. I mean, the U.S. is bringing a huge volume of oil and gas, in particular gas, onto the scene. So, sounds like DCA, right? Yeah, dollar cost averaging is a constant contribution at a fixed rate. And that is a very, smart way to invest. So you're not getting, big changes in how much you invest in the market. Well, it's 2:05. There's 231 people on the call. I appreciate everybody being on here. And, we're going to close it off pretty soon. But this has been the longest time that I've gone through. We had a lot to go through in the presentation and a lot of things to look at. And I want to thank everybody for joining and, asking the question that you've been asking. I really love coming on here and talking to you because it's a chance to communicate about what we're doing so that you truly understand it. I believe that the more that you understand it, the more comfortable that you'll feel. And I've tried to design my methodology, my system, based upon the way I believe, the way I think. And that's why you see it's aligned with who I am and what I do. ABB says you expect Fed cut 1 or 2 by September or in September. I don't know when it's going to happen, but I still think that there's going to be a big fall in interest rates. So I'm not going to make a prediction about 1 or 2 cuts in September, but from a longer term perspective, I think we are eventually going to see interest rates come down. All right, that's it for today. I want to thank everybody for coming, and I hope that you're having a wonderful Monday. Hopefully you learned something through this. There was a lot of slides that I went through, but hopefully you've gotten something out in it. If you've got more questions, feel free to reach out to me. And you can reach me on LinkedIn. You can reach me on Twitter, just Andrew Stotz. You can reach me on Instagram or any of those places. I just want to thank you all for participating. Have a great day, and we'll talk soon.
การลงทุนก็เหมือนกีฬาวิธีเอาชนะมันมีหลากหลายสไตล์คุณเป็น 10 follower contrarian หรือ long term investor หาตัวเองให้เจอสำเร็จได้สวนบ้างดิใจ จะให้เขาชกอย่างเดียวหรือไง
การลงทุนก็เหมือนกีฬาต้องฝึกต้องลอง
เรียกสไตล์การลงทุนผมว่าเป็น long term growth นะครับก็เป็นสไตล์การลงทุนในระยะยาวอย่างยั่งยืน
ดีชกต้องมีกลยุทธ์จังหวะเข้าออกเราต้องรู้
เมื่อคืนที่ผ่านมานะครับผลการประชุมของธนาคารกลางสหรัฐ
ต้องเรียนรู้
คาดการณ์หุ้นในตลาดที่มองไปข้างหน้าเพราะฉะนั้นข่าวต่างๆที่เกี่ยวกับเรื่องการลดดอกเบี้ยเนี่ยวันนี้ที่ออกสู่ตลาดเนี่ยก็เริ่ม price in เข้าไปในตลาดหุ้นบ้างแล้ว
แต่สิ่งที่น่าสนใจคือถ้อยแถลงหลังจากนั้นนะครับที่บอกว่าเราอาจจะไม่เห็นการลดดอกเบี้ยในเร็วๆนี้ก็ได้ครับ
ครับผมปัจจัยการลดดอกเบี้ยของธนาคารกลางสหรัฐก็ยังเป็นปัจจัยที่
และถ้าอยากชนะในเกมนี้
มองให้ขาดสิว่าจะชนะเกมนี้ยังไงสู้หน่อยลุกขึ้นมาหาตัวเองให้เจอสำเร็จได้ลุยต่อลุยต่อ
ไปนะโอเคนะพร้อมนะชก
มองขาดทุกโอกาสการลงทุน Phenomena Ahead of the Game